Hey everyone, and welcome back to the channel where we dive deep into the fascinating world of hard-to-borrow stocks and potential short squeeze setups. Today, we're peeling back the layers on a very interesting microcap name that's hit our screener with an incredibly high cost to borrow. But first, an important reminder. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. With that out of the way, let's talk about BIYA. BIYA is a microcap stock that recently caught our attention due to its exceptionally high cost to borrow. This stock has an estimated float of just 2.7 million shares, which is a very small number in the grand scheme of the market. Now, looking at the recent price action, it's been incredibly quiet. Today's change is plus 0.0%, the last 5 days show plus 0.0%, and even over the last 30 days, we're seeing plus 0.0%. The volume tells a similar story. Today's volume is 0 shares, the 30-day average volume is 0 shares, leading to a relative volume of 0x average. This extreme lack of trading activity is a crucial detail we'll explore further. What is cost to borrow and why it matters? So, what exactly is cost to borrow, or CTB? When a short seller wants to bet against a stock, they first have to borrow shares they don't own from a broker. This isn't free. The cost to borrow is the annualized interest rate short sellers pay to hold their short position. When this fee is very high, it signals that the stock is hard to borrow, meaning there's limited supply of shares available for shorting, or very high demand from short sellers. Fees can easily exceed 100% annualized, indicating extreme scarcity or high conviction from existing shorts. Why this stock is hard to borrow right now? This brings us back to BIYA. Our screener flagged BIYA with an astronomical cost to borrow fee of 897.1% annualized. Show tax, CTB, 897.1%. This is an incredibly high number even in the world of microcaps. While the exact number of shares currently available to borrow is unknown, the staggering CTB rate strongly suggests a very tight supply. Our internal composite squeeze score, which combines various factors like CTB, float, and momentum, currently rates BIYA at 53.5 out of 100. Despite the zero trading volume, the high CTB tells us that if someone wanted to short BIYA right now, it would be extremely expensive. Squeeze mechanics explained. Now let's quickly explain what a short squeeze is and why this data matters. A short squeeze occurs when the price of a heavily shorted stock rapidly increases, forcing short sellers to buy back shares to limit their losses. This buying back, or covering, creates additional buying pressure, pushing the price even higher in a cascading effect. When a stock like BIYA has a high cost to borrow, it means short sellers are paying a significant premium just to maintain their positions. If the price starts to move up, that cost combined with potential losses can create immense pressure, forcing them to cover. However, it's vital to understand that a high cost to borrow does not guarantee a squeeze. It can also indicate strong conviction among short sellers who are willing to pay those fees because they believe the stock will eventually decline. Dilution risk check. One critical factor to consider with any potential squeeze play is dilution risk. Dilution occurs when a company issues new shares, increasing the total share count and potentially lowering the value of existing shares. Even with a high cost to borrow, significant dilution can flood the market with new shares, offsetting any scarcity and negating a short squeeze thesis. For BIYA, our check found no recent dilutive SEC filings, no -1s, -3s, or 424 BS within the last 90 days. This is a positive sign for any short squeeze thesis, as it suggests the company hasn't recently added to the share supply. Recent reverse split watch. Another important piece of the puzzle for BIYA is its recent reverse stock split. BIYA executed a 1-4-10 reverse stock split on July 13, 2026, just 15 days ago. Show tax reverse split 1-4-10, 2026 -7-13. A reverse split reduces the total number of outstanding shares and proportionally increases the share price. For example, if you had 10 shares at $1 each, after a 1-4-10 split, you'd have 1 share at $10. While reverse splits are often seen as a desperate move by struggling microcaps, it's a historically observed pattern that many microcap stocks can see renewed volatility or even a price pop within about a month after a reverse split. This isn't a guarantee, but it's a tendency worth noting, especially given BIYA's extremely quiet trading volume since the split. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Given BIYA's unique situation on microcap with an extremely high 897.1% cost to borrow, an estimated float of only 2.7 million shares, no recent dilution, and a very recent reverse stock split, yet currently showing zero trading volume, what should we watch for? The most immediate factor would be any significant increase in trading volume. Highlight volume on chart. If volume starts to pick up, it could signal renewed interest, and combined with that incredibly high CTB, it could create interesting dynamics. Also keep an eye on price momentum and any future changes in its cost to borrow or the availability of shares to borrow. So, BIYA presents a fascinating, albeit extremely illiquid, case study right now. Its sky-high cost to borrow suggests significant difficulty for short sellers, which could become a major factor if any buying pressure emerges. Remember, the market is complex, and microcaps, especially those with such low liquidity and recent corporate actions like reverse splits, carry elevated risks. Always approach these situations with thorough research and a clear understanding of the risks involved. If you found this breakdown helpful, please hit that like button, subscribe for more deep dives into hard to borrow stocks, and let us know your thoughts or questions about BIYA in the comments below.